With most investors going about life, investing, and retirement planning as if nothing unusual has happened to our financial system, not realizing the repercussions of the 11 trillion that's been pumped into the US financial system in the past 18 months alone. I just want to share with you a report we have just put out. At least 4 billionaires have stated publicly that Americans aren't paying enough attention to this development. And now a former Goldman Sachs banker says sooner than most people think, millions of Americans will potentially be pushed down out of the middle class, out of private retirement, and out of a decent life based on independence and privacy into a collectivist nightmare he calls financial lockdown. So find out how to protect yourself, your money, and your family with a free copy of his new report. In it, he'll show you the 4 steps he recommends that you take immediately. So if you'd like a free copy of the report, you simply have to go to 2022wakeupcall.com. Again, that's 2022wakeupcall.com. Hi, this is Daniela Cambone. Happy Monday morning. Welcome back to Stansberry Research. We are talking rising wheat prices today and what they can really suggest. My guest today says that spiking wheat prices indicate 2022's endgame may remind us a lot of 2008 as rapidly rising commodities, especially food, pressure consumer sentiment and raise the threat of recession. Back with us today is Mike McGlone. He is the Commodities Strategist over at Bloomberg Intelligence. Mike, always good to be with you. Welcome back.
Well, hello, Danielle. Thanks for having me back.
Yes, lots to cover this Monday morning with you. Let's talk about surging wheat prices here, because I found your commentary interesting, signaling that it's bringing us back to '08 days and what it may be telling us.
Yeah, I think wheat is one of the most significant in terms of how much Russia, Ukraine percentage of global exports, maybe up to a third. But it's also food. And to me, it's just part of that whole tide that I think is not a potential for recession, but almost a guarantee we will get a global recession out of this. And add to that, those of us who remember living through the Cold War, what you see on the tape that, quote, the Russians are coming has happened, and it's pretty horrible. So I think this is just part of that narrative. So wheat is up, limit up its second day in a row. It's right near the all-time high, which is significant. In 2008, it's taken that long to get there. But the key thing about wheat, Danielle, is it's typically you can bring on that supply right away, most notably from Canada and the U.S., because you just plant more wheat and you you bring on land that you weren't planting, or you switch to different crops. But it's that cutback in fertilizer supply from Russia. That's significant for the long term. A lot of that, Russia is one of the largest suppliers of nitrogen fertilizer on the planet, potash and stuff like that. And if you cut back fertilizer, we're probably going to have a long-term drop in yields. Now, that's not going to affect North American producers because we have plenty of nitrogen anhydrous, as we call it, in the corn belt, which is where I'm from. But that, to me, is more enduring. And that, to me, is why it's significant. And it's also why I think the grain prices are going to stay high for a while versus crude oil much more, and copper much more likely just to collapse, because that's what they typically do in these environments.
Interesting. Well, across the board, we are seeing banks and forecasts turning extremely bullish on commodities. You know, Goldman Sachs saying we haven't seen a commodities crunch like this in the longest time. So overall, how does this change your outlook for commodities in 2022, Mike, given this black swan event that we're seeing of Ukraine, Russia?
Well, that's the key thing. Goldman Sachs was predicting it before for organic demand pull raises, which I didn't really agree. This is a black swan event. This is the most significant armed conflict most of us have seen in our lifetime. With the analogy I heard this weekend, which I was very fearful, was it basically have the equivalent of a global suicide bomber with nuclear weapons who doesn't care. And there's not much we can do. And that's just what, so the significance is the market's priced in for a major supply shock, meaning that supply from Russia crude oil is going to leave the market. That, to me, is wrong, because a lot of that supply is going to go to China. That was an agreement from before the Olympics, and China is still the world's largest importer. The significance of the numbers are quite damaging for the price, and that is Russia's supply was maybe, in terms of net exports, maybe 6% of global exports of crude oil. It's about the same Kuwait was in 1990. I remember being in a trading pits, and crude oil basically went from 20 to 40. It got to about 2 times its I'd say 60-month average. We just reached that this morning. We got to 130. So if there's any sign of a market that's going to do what's done in the past, sure, we can keep spiking like this, but at some point you're going to turn around and it's going to be down 50%, not in a day, but that's just what's happened in the past. Because I think the greater risk is demand destruction, global recession, and that's happening. But the bottom line for us, Danielle, is North America commodity producers will crush it in this environment. The average cost of U.S. shale crude oil is now below $40 a barrel. That's been declining from 70 in 2014. And if you add into Canadian oil sands, there'll be a massive surplus of liquid fuels. I say liquid fuels because I'm from a farm background, and a significant portion of unleaded gas is now ethanol. That this is going to be a major dichotomy. It's going to push Europe mainly into a recession, push Russia, I think, into a complete economic collapse, and the U.S. and Canada should come out fine once we get past this recession.
Okay, so that's an interesting point. Going over my morning notes earlier, Mike, I was looking at how much European countries, the list of how dependent they are, in terms of ranking on Russian oil, and so dependent on Russia for energy. Do you think this will finally be the change that will cause them to look elsewhere?
Oh, gosh, yes, completely. It's just a matter of time. I mean, we all know Germany kind of kicked out the nuclear too fast and went solar too fast, but that's just going to completely accelerate the incentive to go renewable. I mean, I have an electric car, I have solar panels, so I know there's some experience. They're great technologies, but you just have to make sure you have that backup. My electric car is a plug-in hybrid because when I need gas, it's great. It's really cold. There's nothing like fossil fuels. So it's going to completely accelerate. And I think this is going to push Russia back to, way back to the old world that is dependent on fossil fuels, and the rest of the world that will be no longer dependent on fossil fuels from dicey sources. And we're going to find alternatives. In the meantime, the U.S. is the world's largest exporter of liquefied natural gas. That's going to accelerate, not so fast, but it'll be all going to Europe, a lot of it. So the whole natural gas will go up on a world scale. But if you look at the U.S., the price around 5 on the screen is well below the peak from 12 in 2005, and it's still about 2 times the U.S. cost of production.
Mike, let's talk the metals now, since you and I have spoken about gold and silver and platinum and palladium in the past. As we're speaking right now, gold, looks like it wants to close in on the 2000. Not there yet. Where does it go from here, Mike?
I think it's a matter of time that gold crosses that $2,000 an ounce Rubicon of resistance and never looks back. It's so overdue, technically, fundamentally. I think a key indicator for us, Danielle, it's obviously it didn't do well in inflation. It's not doing well in inflation. Its deflation is a greater risk. The key indicator I'm watching is that U.S. 30-year long bond, which I expect to decline and expect the gold to break out. But we have to admit, gold does have major competition from the digital version, that's Bitcoin. So I think gold is naked. It's not paired with Bitcoin anymore. Now you see Bitcoin's down in the year, but it's way outperforming on a risk-adjusted basis the stock market. So what you're seeing right now, I think, is the whole tide is going out, which is helping gold. Finally, the stock market is giving up some of those excessive gains for the last few years. Gold should benefit. Bitcoin's going down initially, but then I fully expect it to come out ahead. And but the key thing about gold is it's being replaced by digital gold. That's a fact. It's a question of endurance. And I view gold as basically naked, if not paired with some Bitcoin in portfolios.
Okay, and I'm going to ask you about Bitcoin in a second. But just looking at palladium, soaring to $3,000 an ounce, we know that 40% of palladium supply coming out of Russia. Is this going to be just a short-term run, or you think these prices are here to stay?
Norris nickel, I think of the people I know there, and you think of nickel too. It's a question, typically it's not, obviously the key thing about palladium is it's completely substitutable with platinum. That's taken forever, but now you have some major incentive to do that. And so I don't see it as sustainable for palladium. I think for platinum it is. And I have to admit, I've thought that for a while, but the prices you see on the screens right now and see these spikes, the key rule, and let's use that macro, the biggest one of all, crude oil. The key rule is crude oil has dropped 80%, 3 times since that peak in 2008. We're still below that peak for a reason, because North America is the world's largest net exporter, and before we were an importer. And that's what's happening in commodities. Platinum and palladium, yeah, we need them in hybrids and vehicles, but they're complete. The biggest retooling on the planet in the world is happening, the shift to EVs. So sure, I have to point out the facts of where the demand's going, and these and the shocks we should expect from demand at these levels. It's just a rule. It's just a rule of producers. When they make that much money, you got to be careful with the actual underlying price.
And Mike, I had to look twice at the price of rhodium today as we're speaking, up $1,000. We're at 20,000 an ounce for rhodium now.
I haven't watched rhodium too much closely lately because it's kind of out of my macroeconomic purview. But I see that, Danielle, and I remember I have my trading coat on in the trading pits and dealing with customers who would get stopped out and lose their jobs or their home. And I feel bad for the people who are getting hurt there. And you know what's happening. You know you're going to see those stories. But don't underestimate the higher price cure. And again, you mentioned early on, this is a major black swan event. It might be the biggest in our history when you have this major war in Europe. And let's just look at who's going to be, how we can properly adjust and make our decisions to do well in this environment. And the good news is North America is a bastion of safety at the moment.
Mike, I want to bring up Bitcoin now, because the last time we spoke, you were eyeing 100,000 Bitcoin. We were talking around the time the ETFs were launching. That was the catalyst you were seeing that would push the prices higher at the time. What's your forecast now?
The equivalent happened in Ethereum, and my forecast is it's a matter of time that Bitcoin gets to $100,000. It could go to 31st as the tide ebbs, as we mentioned. I fully embarrass the stock market because of recession. It'll drag Bitcoin down, but the facts of Bitcoin is supply is going down. That's by code. Demand and adoption are going up, and I expect that to continue. And the key fact about Bitcoin is it's less than 1% of global portfolios. Yet I fully think that most managers on the planet who run money realize we got to have some of this, just because if it just continues to do what it's been doing in a world going digital, this is a global digital benchmark, might as well get allocated. And it's proven all the naysayers wrong. So this year to me is another one. It's down about the same as the NASDAQ, despite the fact it has a much higher volatility. So I see divergent strength this year. I think it can go lower in the short term, but in the long term, to me, $100,000 is a matter of time.
Mike McGlone of Bloomberg Intelligence, thank you so much for joining us here this Monday for the recap.
Thanks for having me, Danielle.
And thank you so much for watching. We'll have more coming your way, so be sure to stay tuned to Stansberry Research. In the meantime, don't forget to sign up for premier content at danielacambone.com. That's it from me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.